If you're looking to buy a house, you're in the right spot. Today, we're gonna talk about down payments. I'm gonna go over the percent you put down, what's PMI, understanding the exit, what that means, and hey, why 20%? Let's jump in. Down payments, how does it affect my loan? If I put 5% compared to 10%, how does that affect my loan? Why do I think I need 20% to buy a house? So let's get into it. The percent down, you gotta break this up to demonstrate that there's multiple types of loans. You got VA loans, FHA loans, conventional loans, rural development loans. You've got an array of different loans that are associated with different programs that have different down payment requirements. There's anywhere from 3%, 5%, 10%, 20% down. And if you're doing VA, you might even get 0% down. PMI. PMI stands for Private Mortgage Insurance. This is put on your loan. It's meant to protect the bank if you default on your loan. Why do they have it? Because they don't trust you. That's why they have insurance on your loan. Who pays for that insurance? You do, every month. It's like money to the wind. It doesn't go towards your principal, doesn't go towards your interest. PMI stays on the loan until there's 20% equity in your house. That 20% equity could come from making payments, the market. There's so much growth in the market. You could ask them to reevaluate and see if you cross that 20% barrier. But understand the reason that they have this is to protect the loan from a default. Until you're at the 20% barrier, they're saying you don't have enough at stake. We don't trust you to not walk away from your loan in default, and that's what the mortgage insurance is for. That's what it's built for. That's why it's on your loan. When you talk about why 20%, 20% is that equity line where you don't have to pay private mortgage insurance. Super important, not many people get told this. If you have an FHA loan, your PMI exists on your loan for the duration of that loan. You have it for 5 years, 10 years, 20 years. Unless you refinance and switch from FHA to conventional, even past the 20% threshold, you're gonna have PMI on your loan. If you go FHA, you wanna put yourself in a position where you can eventually refinance out of that loan and into a new one. The exit, you've got to think about the exit as far as a percentage wise of equity. In order to sell your house, it costs money. It costs about 8 to 9% of your equity in your house to sell. That means if you have a $200,000 house, it could be between $16,000 and $19,000 just to sell your house. Why? Well, first you got to start off the commissions just to sell the house working with an agent. We do 6% commission. That's the standard in the industry. 3% is for the sale side, 3% for the buyer, whatever agent brings the buyer, that's split. The transfer taxes and the title cost pretty much make up the other 2%. So when you're looking at how much it costs to sell, understand that if you're putting a 3% down payment, a 5% down payment, if you wanted, you're not even in a position to sell that house right away if you needed to. If you did, it would cost you money to sell. Just a heads up, I know that 6% is a lot. You try to save money on commissions and do it yourself. I've seen more people lose money off the overall price of the house than they would have gotten if they paid a commission and actually would have made extra. As agents, we know what we're doing, how to negotiate. Think about the exit. If you put 3% down, you're putting 5% down, know that you've got to be in the house for a number of years before you even get to a break-even point of if I wanted to sell, let alone, hey, we're gonna have extra equity to sell, move on, put it towards our next down payment. If you're thinking about exiting and you've only got 3 or 5% down, another idea is, can I rent the house? If you can rent the house, that's a great avenue to go down. You can't use the equity, obviously, if you were to go buy another house, but it helps cover it. The house is in a good location. It won't be hard to rent. You can get good tenants. When we talk about why 20%, other than the fact that it takes PMI off right off the top of your loan, it actually puts you in a position where you're able to maneuver within a market if there's ups and downs. If I lose 5% equity in a year, and for whatever reason, I still have to sell, I gotta move, I'm in a position where I can do that. If I have 5% down and the market goes down 5%, my home is worth dead even. I mean, I could be in trouble. I might not be able to get out. So this allows you a little bit more freedom within the market, that if you had to sell, even for a little bit of a loss, you can sell, you've got the money to do it. Now, when we talk about how much down, 3%, 5%, 20%, unless I can reach the 20% threshold, I personally, I'm not your financial advisor, what I do with my money is I would go 3 or 5%. I wouldn't do 10% because the difference between 5% and 10%, let's say you buy a $200,000 house, 5%, $10,000, you've got to understand that that $10,000 on average takes about $50 a month on your mortgage. I'd rather have $10,000 in my pocket than $50 a month off my mortgage. That's just me. When you're buying a house, you're getting in there. Something could happen unexpectedly. Something breaks. You need money. Your furnace goes. You never know what's going to happen when you buy a house. Make sure that if you're deciding between 3, 5, and 10% and you're not at the 20, understand that you want probably good 6 months at least of financing, hopefully, set aside after you're in that house. And if that's accomplished by doing a 3 or 5% down instead of a 10, that's what I would do. Thanks for watching. I'm Ciaramella, the creator of LookingToBuyAHouse.com. I appreciate you. We are here to help you, give you guys value. And if you have any questions, drop them in the comments below. As always, keep smiling. This should be an enjoyable process.